All right, welcome back, everybody. My name is Josh here from YBLA, Your Best Life Academy. And today we're going to jump back into the practice questions. I've been getting a lot of messages, both in the comments here on YouTube and through our social media, through our Facebook and Instagram, that you guys want more content having to do with practice questions. So that's what we're going to be doing today. Now, I'm very grateful that I've gotten to see a lot of you guys joining us from different states. So be sure, folks, to put in the comments or send us a message on social media on what state you're joining us. Because I know right now I'm just making videos that pertain to the state of California. But the wonderful thing about California is that we actually cover a lot of other states' rules, regulations, how they do things. So there's a lot of similarities. It's just the order is going to be off. Like when I say chapter one for California, that may be your chapter two, it may be your chapter three, right? But it's still the very similar concept. So don't get caught up so much on the chapter that I'm discussing, but focus more on the concepts that we're going to teach here. However, depending on how many comments we're getting on these other states, we just may start making content and other videos on that state. So be sure to follow us, be sure to like, be sure to subscribe, folks, and be sure to put what state you're joining us from so we can start including videos on that. For today, we're going to jump into the state course material. We're going to jump into chapter one. So let's go ahead and kick it off and get started with that. If only we could get it to work, right? There we go. So let's jump into it. The program that we're going to be using today is for the Schooling for Exam FX. So we're going to go to chapter one, basic concepts. So let's look into it. So we're going to be doing this test live. Okay, so we're doing it live, folks. And the good news is we're going to be able to, I'm going to give you guys my thoughts as we're doing it because I want you guys to start getting used to having an inner dialogue when you're looking at these questions. So let's jump into number one, right? Which of the following statements is not true concerning insurable interest as it applies to life insurance? So right off the bat, reading this question, you got to realize that the key word here is it's not true. Okay. So what does that mean? It means we're looking for the lie. We're looking for the lie in what? Specifically, talking about insurable interest. See, I highly recommend that when you're reading this information or when you're reading a question, be sure to identify the keywords first. Once you've identified the keywords, it's going to make it a lot easier to know what you're looking for. So if you remember, insurable interest is something that needs to exist at the time of application, and it has to deal with the policy owner and the insured, the person being covered by the plan and the person that's buying the plan. They need to have this insurable interest, meaning if the client, the insured, were to pass away, it's going to affect the policy owner financially. So for that reason, they are permitted to buy a life insurance policy. So let's look at these options. And right off of the bat, I feel like A is the correct answer, but just to be safe, let's read the rest. Perfect. So I'm going to go with A, okay? So let's break that down, and that is the correct answer. As you can see, folks, a lender. So here's the answer. Let's read the question and the answer. Let's tie it together real quick, right? So the question was, which of the following statements is not true concerning insurable interest as it applies to life insurance? And the answer that is a lie, that is not true, is a debtor has insurable interest in the life of a lender. That is not true, folks. They do not have that. The lender has insurable interest on the life of a debtor, not the other way around. Okay, that does not work. The debtor does not have insurable interest. That's why, because the question was asking for the lie, that's how we get that question. Moving on to question number two. Peril is most easily defined as what? So the key word here definitely is the word peril. If you remember, I think on chapter one of my YouTube videos, we talked about hazards, perils, and then loss, right? So peril is the cause of a loss. It's an accident, right? So let's look at some of these options. And then we just talked about it. We just said it's the cause of a loss. So we're going to go with C. Let's see if that's the correct answer. And that is the correct answer. Remember, perils are the cause of a loss, and that's what they are insured against. That's why people buy insurance. So the correct answer was the letter C. Moving on to the next question. Question number three. A tornado that destroys property would be an example of which of the following? So again, going back to that concept, we have hazards, perils, and then losses. A tornado is a specific event, right? It's a named accident. So we had talked about this in our video for chapter one. What is when they give a name to a specific accident? What is that known as? I would have to say it's the letter B. Let's confirm if that is the correct answer, and that is the correct answer. The correct answer is it is known as a peril because they gave the accident a name. Like if they would have said earthquake, fire, flood, tornado, hurricane, they named the accident. They didn't just say accident. That is now considered peril, okay? When they name an accident. Number 4, adverse selection is best described as what? So again, you got to know what adverse selection is. So adverse selection, to keep it simple, is basically companies having to give people that maybe have poor health or higher risks or higher risk than average people, still give them the opportunity to be able to get insurance or at least to apply for insurance. Just because somebody has an existing medical condition or illness doesn't mean you can disqualify them right away, right? You got to give them a chance and kind of look into their situation because everybody's situation is a bit different. So that's what adverse selection is. So I normally associate it with something having to do with poor health when you're not the healthiest, right? So let's look at some of these options. So I think A, as weird as it's worded, I think that's going to be the best option, and that is the correct answer. The correct answer is, let's read it down. Adverse selection is best described as what? On the options here, it's best described as risk with higher probability of loss, seeking insurance more often than other risks. As you can see here in the explanation, adverse selection means that there are more risks with a higher probability of loss. I talked about that poor health, right? To purchase and maintain an insurance, then the risks present the lower probability. Underwriting must guard against this. Well, that's a lot of work. If they don't have the best health and they have high risk, they're still given an opportunity to apply for insurance. That's what adverse selection refers to. Let's go on to number 5. Installing a deadbolt lock or deadbolt locks on the doors of a home is an example of which method of handling risk. So if you remember the methods of handling risk, there was 5 ways. It was an acronym called STAR, right? So that was the acronym for the methods of handling risk. So here the person is doing what? They're installing deadbolt locks. So what are they doing? Based on these letters, I'd have to go with the first R. They are trying to reduce the chances of people breaking into the home, right? Just because you install locks does not mean that they're not going. You're avoiding people breaking in. You just reduce the chances of them succeeding. So remember, it's steps taken to prevent a loss from occurring, and installing locks is a perfect example of reduction. Number 6, an individual's tendency to be dishonest would be indicative of a what? So this person, what are they doing? The keywords here is that they're dishonest. Indicative is not really a keyword. It just means it indicates or it shows something to someone. So here the keyword is just mainly being dishonest. So when somebody's being dishonest, what is that known as? We talked about different types of hazards, right? Which one of the hazards has to do with being lying or being dishonest? Now, a lot of people are going to get confused between A and C because there's just that one little letter difference. So you got to know the difference. One of them has to do with lying, and the other one has to do with having an indifference to loss, meaning you don't care of the things, right? So when it has to do with being dishonest or lying, the correct answer would be the letter C, a moral hazard. And that is the correct answer, okay? A moral, not morale, without the E, folks. An applicant that is dishonest is completing an application for insurance or submitting fraudulent claims would be deemed a moral hazard and can be uninsurable from an underwriting standpoint. You lie to them. Why would they want you as a client? Because then they're like, what else did you lie to us about? Or are you going to lie to us about? Number 7, the cause of loss insured against in an insurance policy is known as what? So the causes of loss, I apologize. The causes of loss insured against in an insurance policy is known as what? And then what are the causes of loss? We talked about this a couple seconds ago. Notice how they're asking us the same question. They're just kind of wording it a bit different. I have to say I'm stuck between A and C, and it was A. Glad that we picked that one because again, we talked about how what causes a loss? That's a peril, an accident, right? So people, because they said the word cause of a loss, that's why it's going to be the word peril as the correct answer. Perfect. Moving on to question number 8. The protection of the insurer from adverse selection is provided in part by what? So we just talked about adverse selection a couple questions ago, right? People with maybe having poor health or not the best health still being able to help, apply for insurance, right? So how does the company, because insurer with an R at the end refers to a company. So how does a company protect themselves from having so many clients that have high risks or poor health? Well, what they can do is they can do a profitable distribution of exposures, the letter B, meaning they got to find the balance. Yes, have some clients, right? Have some clients that maybe don't have the best health, but have some good clients that are very healthy, that are maybe preferred, that are above average. So you got to find that balance. So the best thing that a company, the insurer, can do is have a profitable distribution of the exposures. Have a little bit of everything. You can go ahead and pause and read that explanation. I think it's going to be better for you guys to just pause. I'm just going to keep going so we can try to get through as many questions as possible. Number 9, events or conditions that increase the chance of an insured's loss occurring are referred to going back to that graph. Oh my God, there's so many questions that are touching on that. So that's why you want to make sure you understand that concept. And you got to be very careful. Remember, we know that the cause of a loss is this, right? We know that that causes a loss. However, look at the question. We're talking about events or conditions that increase the chances of a loss. Remember that I said in order for this to be the answer, they have to give it a specific name. Tornado, flood, fire. Here, they're not giving a specific name. They're just saying an event or a condition, but they're not saying the specific name. So because of that, the best answer would have to be the letter D. Okay, and let's see if that's the correct answer. That is correct. Okay, the correct answer is hazards. Hazards are events or conditions that increase the chances of a loss occurring. Why? Because it increases the chances of you having an accident. Doesn't mean there's going to be an accident, but it increases. The hazards will increase the chance of you having a loss because it can cause an accident. Okay. So because they didn't give it a specific name like tornado, flood, fire, that's why hazards is the correct answer. Number 10, if an applicant, oh, I didn't go back. Sorry about that, guys. Oh, well. So you know it's live. If an applicant for a life insurance policy and a person to be insured by the policy are two different people, the underwriter would be concerned about what? So how funny that this was actually one of the first questions that we talked about. Remember, when you have two people that are two different people that are buying insurance, they want to make sure that what exists, I would have to say it would be the letter D, and that is the correct answer. They want to make sure whether insurable interest exists between the individuals. Remember, why is it that insurable interest is so important? Well, keep in mind, folks, in a lot of the cases, it's very rare, but in 99.9% of cases, life insurance proceeds, money from life insurance, is exempt on a federal and a state tax. Exempt from federal and state taxes. There you go. You don't pay any tax on that money. So can you imagine people just buying life insurance policies on random people? They pass away, they make millions of dollars, and they never pay taxes on it? Of course they don't want that. It's not a business. Life of people passing away is not a business. So that's why insurable interest is required and is important to be noted. Number 11, which of the following is the most common way to transfer risk? So here again, we're dealing with the keywords of transfer risk. So we're passing it off to somebody else. What would be the best way to do that? Well, I would say it would be the letter D, and that is the correct answer. The best way that you can do it is that you can purchase insurance. Why is that a good way of transferring risk? Because God forbid you get into an accident, who pays you or the insurance company? The insurance company. You transferred the risk. Number 12, the last question here. Which insurance principle states that if a policy allows for greater compensation than the financial loss incurred, the insured may only receive benefits for the amount lost? Okay. So I'm going to go with the letter D on this one. So let's identify some of the keywords. Insurance principle states policy owner allows for greater compensation than the family. So the insured may only receive the benefits of the amount lost. You're only getting just enough. Okay. So what would be the one that you would get just enough? I'd have to go with D, indemnity, and that is the correct answer. Remember, you can have a policy. Let's say your auto insurance policy covers you for up to $10,000, just to keep the math simple, and it costs $4,000. So your policy covers you for $10,000, but you get into an accident and it's going to cost $4,000 to fix all the damages. Okay, $4,000. So your policy is for $10,000. $4,000 is what it's going to take to repair, restore your car. To, like they said right here, you only receive the benefits, the amount lost, which in this case was $4,000. How much money does the company give you? Well, they're going to only give you the $4,000. They're going to give you just enough money. That action of them giving you enough money to restore something, to put it back to the way that it was, or to the exact amount that you lost, even though you have greater compensation because there's a bigger policy, that is known as indemnity or indemnifying. Okay. Whew. And then, as you can see, we got 100%.